Dan Niles a buyer? A buyer, Dan? That of some things, maybe of some things. Tell me. I mean, I know you expect some bad things to continue to happen, but what are you interested in buying here? Where are you seeing opportunity?
Well, first, just to make sure everybody's clear, my view is that the S&P goes down 20 to 50% before this is all done from peak to trough. So that's the long-term view. This is a very short-term view in that, last Thursday we put out a tweet saying, we thought things were overdone. We had taken our short positions down, which normally average about 55% since we started the fund of our assets is invested short, down to 3%. And we thought the next 5% move in the S&P would be up. So to be very clear, we're viewing this as a short-term bounce. If you're not willing to trade the market, stay in cash, because we're not even close to being done with this market going down. So with that as the preamble, right now what we're looking at is spaces that have gotten just absolutely decimated. And the NASDAQ is nowhere near decimated. But if you look at Chinese tech stocks, for example, using the K-Web as an example of that, that's down 75% from its all-time highs, 75. The NASDAQ's down about 28%. And a lot of these stocks are still egregiously overvalued, even after having come down this much, because many of them don't even have any earnings or cash flow. So that's one of the areas where we think you might have actually seen the near-term bottom, which is some of these Chinese internet stocks. But we're pairing that still with looking to put on shorts back again in tech in NASDAQ for that reason. The other space we like is a lot of what we call the reopening plays, so travel and leisure. So we own some Southwest Airlines, for example. We own some Uber. We own names in that hotel space, et cetera, where we're all going to go out, we're going to go on vacation, et cetera. Whereas, during the pandemic, we were all at home streaming movies, buying things off of Amazon, off of our new iPhone and iPad. So spending is switching from goods to services.
Now, something that keeps kind of running through my head, I wonder what you think of it. As hard as it is for investors to believe that good stuff is expensive when the market is up, it's like, oh, Snowflake, look how fast it's growing. It must be worth more from here stock-wise. It's also hard for investors to believe mediocre stuff is cheap when the market is down. So are there potentially some deals in turnaround stocks or in growth stocks that, maybe they don't really have earnings or cash flow to speak of now, but their models are working? Too many investors perhaps overlooking that, and some of those will survive. At what point is it worth taking a look at those edge plays for the value?
I think you have to have a time component to this. And what people are forgetting is for the last 13 years, the Fed has had your back ever since the global financial crisis. So every drop has been small. It's been very short in time. And you've always made that back because the Fed just kept stimulating. You don't have that anymore. In fact, the Fed is absolutely your enemy right now. And so our base case is we go into a recession in 2023, and inflation is still higher than people expect. In our case, we think it's still 4 to 5%. And at which point multiples just continue to compress. If you look at the 1970s as an example of that, the trailing S&P multiple was 20 times. It got down to 7 times, and you lost nearly 50% of your money during that period of time. And so I think you need to keep that in the back of your mind as the big picture. And I still remember 2000. I mean, I remember Apple with nearly $4 billion of cash on the balance sheet, losing, I think it was $66 million a quarter in cash flow, trading below cash value at its worst. So if you think about that as the backdrop and the fact that we just started raising rates, I mean, and the economy is slowing down. You're seeing companies missing numbers, estimates coming lower, and you've got, whatever the fallout is with the Russia situation, with food prices, et cetera, and that still hasn't completely gotten baked into numbers yet. You still have a long way to go. So for us, we're matching whatever we're buying on the long side with names on the short side where we go, well, yeah, things in smartphone area, PC area, that stuff, you had massive surges in demand, and now that's falling off, and you've got inventories building up, which is something we haven't talked about. And so when companies get that golden screw or that one piece they're missing, you're going to see a big inventory liquidation too. So that's why we're being, I don't want to lead your viewers astray here. That's why we're looking for a bounce, But the goal is to then short off the bounce and sell off of that. Well, maybe we buy names down 75% sitting in China kind of thing. That's what we're trying to do.